Hello everyone, welcome to the Ashworth Wealth Weekly Market Update. My name is Todd McChesney. I'm grateful you're with us here today. A couple quick things we wanted to kind of share with you. We'll kind of jump right into the slide. This slide shows the difference between the Fed funds rate and the European Central Bank rate as far as interest rates are concerned. You can kind of see here the Fed rate is in the black, the European rate is in the blue. What's interesting is even though the European inflation isn't quite under control, you can see that the European Central Bank did drop their rates by 0.25% recently. What's interesting about this is our Federal Reserve has said, well, we're going to kind of wait and make sure. We want to kind of get inflation down to about 2% before we start making any changes. But what's interesting with this is the European Central Bank appears to be making a proactive move because they kind of see what's going on. They want to make sure that they move forward and don't slow down the economy too much. So in this scenario, what we're looking at is, will the Fed actually respond? And you can kind of see from this chart that the Fed is expected to do something before the end of the year. A lot of people think that the Federal Reserve is going to go from 1 to 2 rate cuts before the end of the year, whereas the European Bank maybe do as many as 2 or 3 more rate cuts before the end of the year. So we'll kind of see what happens there. But what's interesting about this is it does appear that inflation is kind of starting to subside. Who knows? Obviously, that can change. There's a lot of factors that play into that. But if you remember, about 6 months ago, we were talking about whether or not the Fed would cut 3, 4, even 5 times this year because inflation has kind of stayed strong. That hasn't happened. So we'll kind of keep an eye on things and kind of see what happens. How does this affect you? Really, what it comes down to on those fixed income pieces in your portfolio. Obviously, the interest rates are being up higher. Any bonds that are maturing at a higher rate now. They're being reinvested. We call that riding up the yield curve. However, if bonds do start to, if the Fed does start to drop interest rates, then those bonds will get some capital appreciation bumps as well. So we'll kind of keep an eye on that. But as difficult as it was for bonds for the last few years, things do appear looking to be really, really good. Whether the interest rates stay high for a while or whether they end up cutting them, either way, bonds will be very, very positively impacted in the next little bit. So we'll keep an eye on that. So the main thing is just to notice that things are starting to happen. Sometimes we lead the charge. Sometimes the European Central Bank leads the charge. It looks like in this scenario, the European Central Bank is basically saying, hey, we can kind of see the end of this inflationary pressure. We're going to start to decrease interest rates right now, and I think the Fed will probably follow shortly. We'll be waiting to see exactly when and how that'll work. So once again, if you have any questions, feel free to reach out to our office. Feel free to forward this to any friends that you have. We're more than happy to answer any questions that you have, and we will look forward to seeing you guys next time. Thank you. Talk to you soon.